welcome everybody. Thank you for being with us today. We are broadcasting live, Family Office Insights here outside of Tampa, Florida. And as many of you know, I've been in Florida. I haven't abandoned New York City. I'm just following the sun and running from the Rona. So, and we also have our friend Nicholas in Connecticut, and we have Karl in Dublin, Ireland. So thank you all for joining with us today. We have a lot of attendees. Just a little Zoom housekeeping. We're encourage and welcome any questions you might want to have along the way. We can't see or hear you, but you're welcome to put them in the chat box and the Q&A, and we'll get to as many as we can as we go along here. The subject matter, as you all know, is in the frothiness of the stock market and the limited amounts of places you can find alpha. We're going to talk a little bit about the science behind finding alpha and some practical ways to do that, and more importantly, some opinions from people who are following the math and really understand what's going on here. I want to just thank Nicholas and Context 365 for collaborating on this webinar today. Nicholas has been super helpful, as has Michael and Context 365. And as many of you know, it's a platform that is owned by a family office and is super robust in the ability for not only managers to find institutional and family office investors and other investors, but it also is a method for investors to narrow their focus into things that they have mandates for or are interested in investing in. And it also has a collaboration mechanism where you can communicate directly within the platform. And they've done some really interesting and amazing events, and it's institutional quality stuff. So you're going to hear more from Nicholas about that later. So our subject matter today, like I said, is to have some thought leadership, I can call it that, because I'm not the one saying it, or delivering the thought leadership around alpha and what really is the math behind alpha and how to do it, and some research. And I promise you it won't be boring. And we're not going to show you a research paper with all kinds of stuff you have to look deep in, although that's available, as you well know. So with that, we're going to be recording this today. So if you want to visit it later on the Family Office Insights YouTube channel or share it with others that might benefit from what you hear today, you're super welcome to do that. And again, please feel free to ask questions in the chat box or the Q&A. And off we go. I'm going to hand it off to Nicholas. He'll tell us a little bit about Context 365 and himself, and then we'll have Karl come on. You can see Karl there now. So welcome, everybody. Thanks for being here.
Thanks, Arthur. I'm going to be very brief. I'm Nicholas Longano. I'm a senior strategist at Context. I've been an entrepreneur for decades now, after having sold my company to Microsoft back in 2006, and have spent some considerable time in the fintech space. Today, I'm working with allocators, and I help them identify matched alternative investments utilizing the Context platform as well. And as Arthur alluded, while Context is well known for its summits, and by the way, our next one is going to be held in Miami next January. I know there's a lot of excitement for people to get out and get back to meeting in person again. We're also recognized for the platform, Context 365. What that is, and I'm going to show you some runs from it today, it's a sophisticated matchmaking tool. It connects allocators with alternative investment opportunities, and it provides access to the fund managers who run them. So today, really the focus is Karl, and I'm really excited to hear what he has to say. Karl.
Thanks, Nicholas. Pleasure to be here. Thanks, Arthur, for having us, and thanks, Nicholas and Context, for the opportunity to speak with everybody today. So firstly, I'd just like to share my screen if I can.
I saw that.
A little bit of contact
promo in the background there. I like it. Yeah.
So yeah, a little bit of my background. My background really started on the buy side. I kind of grew up on the trading floors and prop shops and private funds. So I traded the traditional commodity markets in a typical prop shop manner. I then moved and ended up specializing in a far more niche market where I traded the price of electricity across the US wholesale grid from an energy and congestion point of view. After doing that for a few years, I moved over as a hedge fund manager with a multi-strat fund in New York City. That's really where I got the initial exposure to the hedge fund world, and the investment manager also ran a fund of funds business as well. So I got insight and exposure into all the areas of both the internal multi-strat fund, but also the fund of fund business too. I moved back to Ireland about 3 years ago. I am on the faculty in Ireland's top university, where I supervise master's and finance students' research theses. When I got back to Ireland, I also built up an alternative investment consultancy company. I built everything from the investment philosophy and strategy, manager sourcing channels, manager analysis models, an ODD framework, and worked with family offices primarily in Europe to help them diversify their portfolio from their core knowledge, but also from the traditional asset classes as well. I then moved all of that infrastructure in with Athlon Family Office. So in Athlon, we have 4 arms. 3 of them are investments, 1 is sports and education. The 3 investment arms go across private equity, trade finance, and hedge funds. I run the hedge fund arm. So again, pleasure to speak, and look forward to going through the content that we have today. So I initially want to start with, what is the current environment? What are we looking at? Where have we come from? Where are we? And what's the outlook? I think everybody's quite aware of the current environment, and that's probably why we have a chance to speak with each other today. The equity markets have been bubbly for a long time. Last year, we had COVID come along and showed us what a market drop can look like. We then had the central bank step in and essentially use their bullets in terms of the monetary policy that they have, reducing interest rates, putting in QE, buying corporate bonds for the first time. And we seem to be back now in another bubble, whether that can be seen through high equity valuations, central bank monetary policy fueled, whether it's in the Tesla stock that we've seen, the price of Bitcoin, the price that NFTs have been selling for, as well as increased inflation expectation. I think we're in a bit of conundrum of what to do from a portfolio construction point of view. So if we look at where we are now and the current outlook, many people that I've spoken to, both on the institutional side, but on the family office investment side as well, have said that their forecast for the next few years in the equity markets is about 5% annualized versus the last 10 years that we've had. So when we combine that with the interest rate environment that we're in and the inflation expectation that many people have within the current market, we really struggle to come up with a portfolio that's going to provide good returns with limited market drawdown going out into the future. That's why we're here. So in terms of equity hedging and the need for it, given the current environment and high equity valuations, there are traditional methods that have been used, but really they don't do what they say they do on the tin anymore. I've heard many people and investors believe that equity long short provides that equity protection. We looked at a traditional 60-40 portfolio and how impressive and important the fixed income market has been for portfolio construction, and then another hedging method using volatility and tail risk. So we've produced these research notes internally and make them available via public industry publications. More than happy to share these links afterwards. So we did an internal research in equity long short, and essentially what we found is that providing portfolio protection is a myth. After we strip out the returns that have been driven by the market, the managers on average don't provide any kind of alpha. So the market returns fully explain the equity long short returns that they've had. Not only that, but the returns have been very cheaply and easily replicated via a very simple 30-70 portfolio, 30 S&P 500, 70% cash. That was done using the Barclay Hedge Equity Long Short Index, and we then used another one the Athlon family office is a partner in, Nielsen Hedge. That one was replicated via closer to a 40-60 portfolio. Not only that as well, but when you combine a 60-40 portfolio of the S&P 500 in equity long short versus S&P 500 in bonds, it wasn't surprising to see that the 60-40 equity bond portfolio provided reduced drawdowns, but it actually provided increased returns as well. In terms of the fixed income market, this is really causing a lot of problems, and it's the biggest area of confusion for investors and portfolio managers in terms of portfolio construction. Traditionally, there's three reasons why you go into fixed income. Number one is the income-like return stream for asset liability management, but really it's also, you used to be able to get a pretty decent yield within the bonds, and the high negative correlation was portfolio managers' best diversification tool. In the current environment that we're in, after the monetary policies that were initiated last year, we now see ourselves in an environment where we're looking at negative real yields. We're looking at a mismatch in the interest rate received to the credit risk taking on due to that central bank intervention and then buying up investment grade bonds and fallen angels as well. And then importantly, this isn't talked about enough, within the media, you see the loss of yield within the bond market being a big hindrance and needing to find that yield elsewhere. Although that is important and true, the biggest implication of the current market environment is the fact that the equities and government bonds have lost their high negative correlation with each other. Therefore, we have lost our best portfolio diversification tool. And then we also look at another very common equity hedge strategy, volatility and tail risk. In the end, although they do well during the times that they are needed, what you were essentially doing is paying an insurance-like premium over a full market cycle, which is negative in the return column. And it's for those reasons that we see not only family offices, but now institutions as well pulling out of this. We recently saw CalPERS decided to not run this strategy internally anymore because it's too expensive. So in light of these problems with equity hedging, we then look at portfolio protection through diversification. So what we did again, through internal research in the equity market neutral and fund of funds side, we analyzed traditional diversification investments that many institutions and investors and family offices take on. Theoretically, equity market neutral should be a very, very good diversifier. But what we have found is that equity market neutral funds over the last 10 years have essentially been driven by beta and provide no alpha. Similarly, they can be cheaply replicated via a 15% S&P 500 portfolio and an 85% cash position in the portfolio. So really what they're not doing is providing that diversification benefit that we assume that they have due to the theoretical setup of equity market neutral. And then we ran a similar study on the fund of funds side of things as well. What we found is performance that really jumped off the page from kind of 2000 to 2007, 2008, just before the global financial crisis. These fund of funds were doing a very good job at providing diversification and alpha. You know, they were bringing in a correlation of about 46% versus the S&P 500. In the last 10 years, that's moved up to 80%. So a diversified fund of funds across multiple asset classes now has around an 80% positive correlation with just the S&P 500. Not only that, but we saw that beta coefficient increase nearly double in the last 10 years. And importantly, their annualized alpha went from 6.6% down to what is essentially nothing, 0.02%. So the traditional fund of funds setup really has lost its alpha generation and diversification benefits. And then there was an interesting study by a friend of mine, Nicholas Rabener, who's the CEO of Factor Research. He came out and looked at private equity. I did a study on it and said, you know what, private equity is essentially the same as public equity. He found that the US private equity returns can be systematically replicated by purchasing leveraged small cap public equities. He says that the economic exposure investing in public equities is highly correlated to the economic exposure investing in private equities. You may wonder why I bring this, given that we have a private equity arm. This is, of course, looking at the large index using the very, very large private equity funds out there. Our private equity arm is more so a deal-by-deal co-investment within the commodity markets, primarily energy, mining, agriculture, and manufacturing. So you're not quite comparing apples to apples there. So again, in summary, we're looking at the current environment. We know we need portfolio construction is a problem, finding yield is a problem. We look at traditional hedging methods, they're not doing what they're supposed to. We then look at traditional diversification methods and investments and strategies. And again, over the last 10 years, they're just not doing what they're supposed to do. So in this next section, I want to talk about both diversification and alpha. I want to give you my thoughts and investment philosophy when it comes to both of these. Essentially, why do we want to diversify a portfolio? It's to reduce the drawdown during periods of market stress, but not just that. Many people focus just on that component, but it's a successful diversification is achieved when portfolio reduction is greater than the return dilution. So I could have a portfolio of 100% in the S&P 500. I can quite easily reduce my drawdowns by holding a 50% cash position. My return drawdown or portfolio drawdown will be reduced by 50%. However, the upside is also reduced by 50% as well. How can it be achieved? A simple definition that I've come up with is by adding a return stream that's fundamentally unrelated to the benchmark's market return. When you look at diversification, there are ways to do it which are easy to access and difficult to access. So on the right-hand side of the slide, I've broken down ways of achieving diversification through easy to access markets, difficult to access markets, and strategy-based strategies as well. So adding a fundamentally unrelated return stream to, for example, an equity portfolio isn't very difficult. It can be cheaply and easily done, primarily through the increase of popularity of ETFs, markets available through ETFs, and strategies available through ETFs. We can quite easily diversify our portfolio with emerging market equities, with bonds, and with commodity markets in a very cheap and easy manner. The question that we need to look at is looking forward from the current macroeconomic environment that we're in and looking forward to our potential return stream over the next 5 years or 10 years. Do I want to be in equities? Do I want to be in emerging market equities? Specifically in North America, where valuations are very high, do I expect a reasonable rate of return over the next 5 years? If I do, I can get quite easy access via ETFs. Similarly, in the fixed income world, I can get quite easy access into ETFs as well. But do I want to be in fixed income given the interest rate environment that we're in and the medium term outlook? We're down near the floor. Interest rates can really only go one way from here over the medium term, and that will negatively affect our bond holdings. And then again, it's quite easy to add diversifying markets that are fundamentally unrelated within commodities, for example. Unlike equity markets that are long-term increasing and incentivized to do so, commodity markets are more cyclical. Therefore, just being long commodity markets via an ETF, it will provide diversification, but will it also provide the same kind of market return that's required, or portfolio return that's required, is a different question. Not only that, but if we do want to get directional long exposure to something like a commodity market, an ETF isn't the only way to do it. You can look at something like the copper market, we know the prices in copper has been going up. If we think that over the next few years we're bullish on copper because of the move in electric vehicles, we can either get exposure to that and diversify our portfolio via an ETF into copper, or we can use a different investment vehicle, something like a private equity vehicle. So for example, in a private equity vehicle, in the way we use it in Athlon, we're able to get in private deals with mining companies where we're able to not only make profit from the increase in copper that we believe will happen from the current price of copper, we're able to get to profit from the increase in copper that we think is going to happen from now based on a mine's operating cost. That provides us extra yield versus something like a cheap and easy to access ETF can do. And then still keeping with the diversification through different markets, there are some difficult to access markets as well. These are markets that either don't have an ETF or index or don't have a very liquid ETF and index. So some examples of these type of markets, and these markets are within Athlon's multi-manager fund that we're currently capital raising for. Some examples of these difficult to access markets that really require a hedge fund vehicle versus a cheap and easy vehicle like an ETF, regional carbon markets, power markets, electricity trading, and shipping. These markets that are difficult to access tend to be small and quite inefficient. And then there's another way of getting this diversification that we look for, and that's strategy-based as opposed to just market-based. So, we can diversify our portfolio via something like an equity long short, or, the famous CTA managed futures trend following strategy, or global macro, and so on. The thing to note in the way that I look at these is these strategies are going to have a degree of overlap with a directional move of the market that they're operating in. So my question is, when I'm analyzing any of these strategies, is how much exposure within just the market direction am I getting, and how much exposure to some other component of the market am I getting? So for example, I look at an equity long short, they can have a gross long exposure of 60%, for example. That's essentially the same thing as me having 60% of that $100 or $1 million, whatever I put into that strategy, just following the S&P 500. So you need to look at how much is just moving by the market and how much is moving by different drivers that the strategy itself is capturing. Similar on an equity, global macro, they tend to invest in every market under the sun. I've read many global macro decks that tell me that they provide true diversification and alpha because they're uncorrelated to the S&P 500. My response to them is, of course, you're uncorrelated to the S&P 500. You're expected to, because you trade equities, fixed income, rates, commodities, anything you can get your hands on. Only 10-15% of your trades are in equities or the S&P 500. So of course you're going to be uncorrelated. But how well can I get similar exposure via going into a basket of ETFs that are operating within those markets? And what is the true diversification benefit that investing within that strategy with that manager versus that basket of ETF within the diversified markets that they operate in is really bringing us in. So,
Karl, I'll just interrupt for 1 second. We got a few questions here, if you don't mind.
Oh, yeah, absolutely. Yeah, of course.
So the question our friend Goodrum is asking is, what ETF do you think is best to get exposure to copper?
I don't know the ticker off by hand, because the strategy that I run, which I think you'll get some more clarity on it after I go through the alpha slide, is when I'm doing up the strategy that we're running in Athlon's multi-manager program, I look at it from a portfolio at a portfolio level. So essentially, I assume that the investor that's putting their 10% or 5% or whatever their portfolio allocation into hedge funds already have exposure to the traditional asset classes and markets via a cheap investment vehicle like an ETF. So I assume that they already have equity exposure via an ETF or commodity market exposure that they can get via ETF. So I'm very much focused on finding markets and strategies that do not fundamentally overlap with directional exposure in those markets that can be cheaply and easily accessed via ETFs. What I say to some family office clients of mine is, look, I think if you want to get directional exposure into copper, I don't think an ETF is the best way. I don't think trend following is the best way. I've had a few managers come to me and say, look, we're about to go into a commodity super cycle, therefore our trend following strategy is going to do very well as these commodities increase. The upside of institutions, of family offices and high net worth individuals is that you're able to access qualified investment vehicles, and you're able to utilize the longer liquidity lockup in order to get exposure to the copper market that you cannot in not only an ETF and not even a hedge fund. You can only get that in a private equity style investment. And the real benefit of that is that you're able to go in, provide funding to actual private mining companies, and you're able to get access and exposure to the increase in copper price, not just from the ETF price of where you bought, but from what the mine's operational cost of that copper is. So me personally, all I can say is personally, I wouldn't invest in copper via an ETF. I'd be looking to increase the returns by getting access to a mine's operational cost and still having that upside for copper to move up over the next couple of years, from the spread that the mining company produces the copper for and then sells to whoever their buyer is. So for example, in our copper deal, the buyer is Glencore.
Yeah, so that's super helpful. There's several other questions about portfolio construction with specific questions about what you're buying. So why don't we do as you suggest and go on to the alpha slide. And then maybe just for a minute, we have a question about which type of data sources do you mainly draw on for your research and derive your strategies?
Mm-hmm.
And which role does alternative data, i.e. non-financial data, play for you? So I just wanted to give you a heads up if you felt like answering that now, or we can, obviously Context 365 is where you draw some information from. So that's the commercial here for a minute, but maybe we can go to the alpha slide and then answer a couple of these after. Does that make sense?
Yeah, no problem. If you just want to repeat those questions to me after the alpha slide, I think, that's no problem at all. So as I said, this is how I view diversification. This is how I view alpha. Now, alpha comes across on the street as something that's just manager skill, and many investors believe that. But alpha is calculated, it's formulaic. It can be explained via the CAPM formula that I have up here. Return equals beta times market return plus alpha. Now, the way I see it, there's two different ways that alpha can be achieved, and I call them variable alpha and persistent alpha. And I don't think you're going to see these definitions elsewhere. These are terms that I personally made up and that I'm providing the definition for, because this is how I view them when I break everything down. So how can it be achieved? Number one, the traditional one that everybody believes: excess returns from market timing, correct stock picks, and/or correct directional investment calls. I think this is what goes into the manager skill category that many people believe alpha to be returned by. Another one is, and I think you can actually note, the definition is the exact same for this alpha that diversification is: bringing in or adding a return stream that is unrelated to the benchmark's market return. Now, the difference between diversification and alpha, at least the way I view it here, is diversification can be achieved by adding a different market, so a return stream from a different market. Alpha is achieved by a return stream within the same market that your benchmark is operating in. So it's an equity manager that's trading only equity products again, bringing in a return stream that's unrelated to the broad equity market that they're operating within. Similar if it's a commodity manager as well. So in terms of variable alpha and persistent alpha, what I mean by these, actually before I get into that, when we're looking at the CAPM equation, one thing that I'd like to talk about is some possible alpha descriptions. And I think it's worth the note and caveat that this beta coefficient is calculated via a linear regression. So is part of the alpha that managers bring in just bad math? Linear regressions have assumptions based on that model that generally all financial data break. So if the financial data breaks the assumptions, then the results of the model shouldn't be believed fully. So that is one note and one caveat that must be thrown out. Another thing is alpha being brought in based on taking additional risk? So what do I mean by that? I mean that, say we have two different funds. We have Fund A and Fund B. Fund A is the S&P 500. Fund B is a single stock fund. Let's just say Apple. It doesn't matter what the stock is. Let's say the S&P 500 moves up 15% in the year and Apple moves up 18% in the year. Based on the calculation of beta being 1, market return being 15, we brought in 3% alpha. But when you look at the return drivers and what risk exposure you are open to, I think that helps paint the picture. So if you're analyzing Fund A, which is the S&P 500, what you're looking at is a diversified portfolio of 500 different stocks. There are two risk types. There's systematic risk and there's idiosyncratic risk. And we know that a diversified portfolio, for example, 500 different stocks, diversifies away idiosyncratic risk. So Fund A, their returns are being driven by systematic risk only. Fund B, my individual stock, is being driven by both systematic risk and idiosyncratic risk, because now I'm open to idiosyncratic risk being particular events, whether it be balance sheet fraud, a successful product launch, a change in management that's unique to Apple. I'm now open to that risk or exposure. So can we then see that the 3% alpha that Fund B brought in was just compensation for taking on idiosyncratic risk, which Fund A does not take on? And I think that's important to think about. When we're analyzing managers, a lot of what I'll speak about the variable alpha is successfully calling additional risk, the idiosyncratic risk that managers are taking on. So variable alpha, what I call variable alpha is more so the traditional definition of alpha that everybody hears. And that's a kind of a return stream that provides excess returns due to market timing and directional calls. So another example could be the S&P 500 moves up 5%, then down 3%, then up 2%. So that would be a 3% gain. But if a manager took the 5% gain, moved to cash because they saw a drop coming, then got back in and made the additional 2% rally, they're certainly bringing in alpha. I think 4% in this case, or something around that. Now that 4% alpha is being driven by correct directional call in the market. Now, the reason why I call it variable alpha is because that manager running that strategy either brings in alpha in a year or does not bring in alpha in a year, subject to them making the correct directional call or making the correct stock pick in that year. So just because they made the correct call in 2019 or 2018 doesn't necessarily mean that they will continue to make correct calls going into 2020, 2021 and onward. So whether there is alpha or not is variable, and that's one way that I look at this alpha generation. What I call persistent alpha is kind of going back to this formula. It's a return stream that's unrelated to the benchmark's market return. So how does that work? How do I get all of my return to be alpha generation? and looking at the formula, it's relatively straightforward. If I can get my beta coefficient down to 0 or as close to 0 as possible, it doesn't matter what the market does, if it's up, down, sideways, because all of this cancels out to 0, and therefore my return equals alpha. So if the risk exposure that's driving the return of a manager is driven fundamentally by risks that are not the same risks that drive systematic risk or the market as a whole, what we're going to do, regardless of how much alpha was brought in a year, it will be persistent because it's driven by different fundamental drivers. And generally what you'll find is this systematic, this idiosyncratic risk, this unrelated risk driver tend to be capacity constrained in nature because it only affects a small part. So if I'm to throw up again another example within equities, you look at something like the S&P 500. You have 500 companies. Let's say that you can only invest $1 into any individual company. Now, you can have a market-wide event that moves the whole market, so all 500 companies, and you can have $500 invested in that. But say there's an idiosyncratic event. Let's say a company comes out and says that they're going bankrupt, or they're fraudulent data or boosted their balance sheet, or whatever the case may be. That one company is going to have a unique price movement that doesn't affect the other 499 companies. Now, that's the idiosyncratic event. Now, if I want all of my manager returns to be driven by this idiosyncratic risk, which is unrelated to the wider market, therefore getting my beta coefficient as close to 0 as possible. If I want it to be only on this idiosyncratic risk, I'm only able to put $1 to work, the $1 that I can put into that company. If I'm a large manager and I have $10 that I have to invest, I may have captured that idiosyncratic event within the market by having $1 in with that company, but I still have $9 in with other companies that are moving the same way as the rest of the market. So there'll be a small deviation will provide me a little bit of alpha, a little bit of diversification, but really what we're getting is the majority of just market movements. Now, the big characteristic of this and the point of this, the capacity constraint nature of idiosyncratic risk or unrelated return drivers within a market is that they operate in an investment universe that's outside one that the large wealth managers, large advisors, and large funds have to overlook. So large wealth managers and large advisors, they're really set up for their largest clients, which are institutional investors. And large funds have extremely large AUM that they have to move. Therefore, they all have minimum capacity requirements. I've spoken to a number of wealth managers, for example. They don't look at a hedge fund unless it already has 500 million AUM, or unless it's running a strategy that can take at least $1 billion AUM. So a lot of these managers, strategies, and markets that isolate their returns on this idiosyncratic risk or persistent alpha, as I call it, they're going to be capacity constrained, and therefore they're going to take themselves out of the investment universe that all the large funds, the millenniums, and all the large consultants, advisors, and wealth managers operate within. So then the last thing that I want to talk about as well, so, given the problem, the current macroeconomic environment, the future outlook, the portfolio construction problem, the problems in current equity hedging strategies, the problem in the traditional diversification strategies, what is a potential solution to this problem? And that's where we put forward Athlon solution. So our solution is our multi-manager fund that we're currently capital raising to launch. And it combines two things. It combines the persistent alpha managers, as per my definition in the previous slide, that operate within an underserved investment universe. Right? They sit in that investment universe below the minimum capacity requirement that all the large institutions have to operate within, and also provides access to return streams of strategies and markets that can't be accessed via cheap and liquid ETFs. Just the last couple of points on this multi-manager fund as well. It's run by myself and our advisor, who's a very good friend of mine. Both of us have been heads of trading, myself fundamental commodity trading within a niche market. I'm a multi-strategy hedge fund manager. We physically traded these markets, these niche markets before from a fundamental perspective. And he has, he's a quantitative trader. He's also a former head of trading, who's the head of trading for Europe for Citadel Securities. So he's an expert in some of the strategies that I'm not, but that fit the bill. They include whether it be statistical arbitrage, high frequency trading, corporate actions, a number of the strategies that they run there. So he helps analyze and screen the investment managers running the strategies that he knows like the back of his hand, like I screen the managers that operate within the more niche commodity markets that take advantage of inefficiencies within the commodity markets. The other thing worth noting about these managers and strategies and markets is it's not a black box. We're not looking at a neural network to find something that's statistically uncorrelated. Everything has a fundamental reason of why dislocations happen, of why they provide diversification or alpha, because they're fundamentally driven by different price drivers. So let me give you an example. Within power markets, the capacity generally closes in around 200 million to 400 million. On the US side alone, you're looking at about 150 million. Now, what drives the price in electricity markets is on the demand side, it's weather, and weather is very variable, and weather is specific to a region. So even within the US, you have natural diversification because the weather system in California has nothing to do with the weather system in New York, which has nothing to do with the weather system in Texas. And you also have the fuel source mix as well, that's different depending on the different geography that you're looking at. The small and inefficient, why? Electricity has a unique characteristic that other commodities don't have, and that it cannot be stored. So it is a constant supply-demand equilibrium that needs to be matched, and when it's not matched, it can be driven by pretty significant price fluctuations within the market. On top of that, it's an old market. Infrastructure is old. It takes a long time to build. So there's a number of reasons why these markets are inefficient. It doesn't matter what equity is doing. It doesn't matter what fixed income is doing. It doesn't matter what any other commodity market is doing, because the power market acts on its own. So that gives an example of one of the hard to access markets that I talked about in terms of the diversification standpoint. And that's it from me. As I said, here's my contact information. More than happy to provide any of the research notes in a follow-up from the markets that I've discussed, that we've produced internally, speak more about how I view diversification, alpha generation, and the current multi-manager fund that we're currently capital raising to launch.
So thanks for that, Karl. Arthur, if I may, and then we can get back into the Q&A. I took the liberty of actually doing some algo runs as well. Am I sharing the right platform here?
Yep.
Okay, great. I just wanted to make sure. So I did some algo runs based on all of the information that Karl has been referring to, particularly as far as diversification is concerned. And just before I share my findings, I know some people came on a little bit later. After the introductions. Context 365 is basically a matchmaking tool, and it connects allocators and alternative investment opportunities and provides you access to those fund managers who run them. We list about 35 funds from about 35 countries. And last year, the platform facilitated around 12,000 meetings and over $46 billion in allocations. So that's the only plug that I'm going to give this over the next couple of minutes. As I mentioned earlier in the intro, Context is another tool in your investment search arsenal. And whether you search for yourself or you work with consultants, right, what we're doing is we're matching you against a broad list of funds offering a wide array of strategies based on your investment preferences and those diversification needs, right? On average, the funds that are active on the platform are producing strong performance, with over 50% of them reporting annualized returns greater than 10% since inception, okay? So back to the search. I used the Context platform to explore the strategies that are supporting a diversified portfolio approach. I was able to find 74 multi-strategy funds which have recorded average annualized returns over 15%. Now, I limited my search just to those funds with a track record over 3 years. And the top performing fund from this group reported an annual return of 114%. That's annualized. On the global macro side, we found 143 funds with an average annualized return of 15.1%, and the top performer there returning 56% annualized. And then for equity market neutral funds, we found 40, an average annualized return of 8.2%, and the top performer in the group, 19.4% annualized return. Okay, so all of these reports are available to our members who have access to all this data. And I want to mention this, and thanks to Arthur as well, that membership for the allocators is gratis, right? It's complimentary on the platform. And beyond the matchmaking, Context also provides detailed fund profiles from each manager, their fund terms, team bios, self-reported performance reports, and marketing debts and pro formas. So that's where I wanted to end. And I really wanted to thank Karl. Over to you, Arthur, in terms of the questions, because I know there's a few.
Yeah, there's a bunch of questions. Some of them are going to be edited by me just because we're going to run out of time here, but so what I was going to ask, and also prompted by some of the questions, the solution that you propose is persistent alpha and variable alpha. Then the question is, okay, can you find those managers that actually are doing what your solution is? And so Nicholas just demonstrated a few, but from a practical standpoint, are you comfortable in suggesting that you can fill your capacity with the funds that fit within your construct?
Yeah, so we already know the managers. They're lined up. I've been doing this for the last 3 years through Ace Capital Investments, the consultancy that I built up, and all of that infrastructure. This has always been my investment philosophy when it comes to hedge funds. I've always believed that we need to go back old school and concentrate on alpha and diversification. And I've always had very, very strict investment philosophy when it comes to this. So we've been building the investment manager universe over the last 3 years. We've ran the analysis on them. A few individual family office clients have already made investments into a few of them individually. So yes, the managers are lined up and ready to go, and the fund structures lined up and ready to go. We've brought Apex Fund Services, who's approved our fund, Grant Thornton for our auditor, and Harney's for our legal counsel.
So when you're explaining, it was fascinating that you can find the zero beta, right? Are they following your methodology, or they just happen to fit into your methodology? Some of the
yeah, a lot of these managers that are included in our multi-manager program, it's what they do. It's a part of their trade setup. The trade setup is extremely important. Is it relative value? Is it market neutral? Are they going long and short the exact same underlying? For example, in exchange arbitrage, there's a very famous one that exists within copper between LME and COMEX, right? You're buying and selling the exact same underlying, but there's a spread that's persistent within the market that's physically bound. So unlike purely statistical relative value or arbitrage, when the spread between the two exchanges goes far enough apart to make up for the transportation costs, the physical players within the market will just move their metal from one exchange warehouse to the other exchange, and that closes it back up. So it's an interesting question that you ask, because even in terms of the ESG movement and impact investing movement that we've seen over the last few years, I've spoken to managers before that say, hey, look, we're not necessarily impact investors or an impact manager or an ESG fund manager, but because of the market that we operate in, it is considered positive ESG, and therefore we fit that criteria. So similarly, these managers that make up our multi-manager program, they are aware of and isolate their returns on these internal market inefficiencies and dislocations which happen, because they also know that that's what provides alpha and diversification and is highly sought after, especially in a world where equities are highly valued, fixed income is down at the floor, and the traditional asset classes have been moving more and more together, really reducing the diversification benefits of what we've all been used to for the last 10, 20, 30, 40 years of investing. The current macroeconomic environment and situation has changed, and we need to start looking outside the box. And one of the reasons why we're able to do this is because institutions can't. Within Athlon, we have two investor bases: family offices, professional athletes. We are able to take advantage of their investment characteristics and that they're smaller and more nimble. And the reason why institutions don't look at these smaller managers, and by small I mean the underlying managers close between about 150 and 600. One manager has $1 billion capacity. The reason why they don't look at them is because their minimum or average ticket size is 50 million to 100 million, and they need a really diverse investor base. Therefore, they can only look at managers that already have 500 million or $1 billion plus, and
They need
the big managers just keep on getting bigger and bigger, which means that their minimum investment size keeps on getting bigger and bigger. So they have to move away from these small inefficiencies and have to start going into the high capacity markets and high capacity strategies. Now, all of a sudden, they're aligned with beta.
So it's a little off topic, but I think it's relevant in the context of, wow, that was a pun. The current environment of how frothy the markets are, let's use that word. So to be controversial, why wouldn't you just stay long? Stay long the S&P. I mean, I think I know the answer, but I'm throwing controversy out there.
Oh, I've never ever said don't be long the S&P 500. When I'm looking at my hedge fund strategy and hedge fund portfolio, my focus is looking at a portfolio effect. So I already assume that you have money in equities via a nice, cheap and easy to access. You already have that market exposure. So if you were to say, yeah, I have 10% of my money in hedge funds and I'm all invested in equity long shorts, but these equity long shorts have a 60% gross exposure to the equity markets. Well, you already have that exposure cheaply in your ETF. Why are you paying 2 and 20, 1.5 and 15, whatever it is, to have 60% of that allocation just aligned with something that you can pick up for 25 basis points? So one note on the why not equities isn't a why not, but it's markets are moving quicker, right? Previously, we were in, quote unquote, the most hated bull run. This was pre-COVID, and then we saw how quick the market was to correct. We went into the quickest bear market in history. Markets are moving quicker these days. You're not going to get that slow grind down anymore. You're going to get a pretty steep drop whenever it happens, and true diversification and alpha generation should have you not related to that, but you're exposed to some other market movers and drivers and dislocations that in an increased volatile environment actually create those dislocations as well. So a high volatility environment is actually positive for a lot of these managers and strategies.
Yeah, totally makes sense. So if one were, this discussion was around your methodology and thinking, and even though we've talked about the fund, the intention wasn't necessarily to promote the fund, but if one was interested in talking to you about deploying capital into the fund, they can speak to you directly, and
Absolutely.
then we'll make sure that everybody's in touch, and likewise with Nicholas, so they can learn about context if needed. One of the questions was, what do you use?
In data, right?
Yeah.
Yeah. So more than happy to. So again, I go about this differently than many people. I don't just take in a big hedge fund database, go through the historical numbers and pick the lowest correlations. I don't filter it quantitatively first. Everything is a qualitative analysis first and foremost. And then once the qualitative analysis fits the investment strategy and philosophy, we then back it up by quantitative metrics and analysis. So what I do first when I'm looking for managers is I receive their tear sheets, I receive their marketing deck. Instead, I have multiple manager sourcing channels, and these cap intro teams, summits, investors, they know what I'm looking for in terms of the more capacity constrained managers, and send me on any that they think are a fit. But first and foremost, I read through what market are they operating in, what strategy are they executing, and what is their trade setup. That's one of the quickest ways for me to disregard them and move on. And then once we understand the markets that they're operating in, the strategy that they're running, what's really important for me is what risks are driving their returns. There's no such thing as risk free. So what I'm looking for is not systematic risk driven return, but idiosyncratic risk. Why do these market inefficiencies exist? How do you execute on it? Why is nobody else doing it, or very few people doing it, and so on. And then we put the quantitative metrics in. So everything is first and foremost qualitative analysis as opposed to quantitative analysis. And in terms of the alternative data question, I think a lot of managers are looking for alternative data to get an edge in a directional call. We don't look at directional calls. If you're making a directional trade, you are going to be aligned with beta, because you're either moving up with the market or you're moving down with the market. So if you make a directional call, then you're going to be aligned with beta, and likely then we're going to have to screen you out, because we're looking for managers that isolate their returns on the persistent alpha, as per my definition of it.
Yep, totally makes sense. So we have a bunch of other questions, but we'll send them over to you so you can answer them directly after because we're running out of time here and have to wrap it up. So
I just saw one question there, Arthur, which I could answer real quick. I saw I can't remember who it was from, but somebody asked what's the minimum needed for the fund launch. The minimum needed is 25 million. But technically, it could be lower. But 25 million gives enough room that it doesn't crush the expense ratio for the launch before AUM grows significantly. And we're doing a founders class, and I've offered an anchor class as well to a couple RIAs if the ticket is big enough.
Yeah, super cool. There was other questions about diversification through VCs and private equity, but we're going to run out of time here, so you can answer those. So we'll put you in touch with everybody.
No problem.
Why don't we have you wrap up with a final comment, Karl, and then we'll ask Nicholas to say something, and then we'll wrap it up.
Yeah, firstly, just happy to be here. Thanks for the opportunity to speak. If anybody has any questions on either the research notes, the portfolio construction, my views on alpha and diversification, and or the fund that we're currently capital raising for, more than happy to go on a one-on-one call and go into whatever depth one wants to go into.
It's super interesting. Really, really appreciated the thoughtfulness of the presentation. Nicholas, thank you for arranging this.
No, thank you for having us and organizing this. And I would invite everybody that's listening in to please join us on Context. If you're an investor, obviously that is a complimentary, and we thank Arthur for that. And in terms of managers, we also have a starter. You need to be listed. You should be listed because we have over 1,000 investors that are constantly looking for opportunities. Just to be listed on the platform, there is no charge to that. So you should be doing yourself that service, at least get yourself on the platform. And then if you're really looking for capital, for funding, LPs, etc., we have special packages, especially to members of Family Office Insights as well, that we can work with you.
Super, appreciate that. Well, that was really, really interesting. Thanks again to both of you. And thank you to the Family Office Insights community. And thank you for joining us here today. And as I always say, thank you for spending with us the only thing you can't make more of, and that's your time. Till next time.
Thanks, everybody. Thanks, Arthur.